Good afternoon, StockCharts users. Today on the Final Bar, we'll open up the Final Bar Mailbag, answer some questions related to ETFs that we've referred to in the last couple weeks. Thanks for all your questions. We're going to do a deep dive on the communication services sector, a number of the names reporting earnings this week, so we'll dig a little deeper into the themes that we see there. Also, the 3 in 3, including 3 charts that you should be paying attention to. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Good afternoon. Welcome to this edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Really appreciate you joining me. Hope everyone had a great weekend and a good start to the trading week here on Monday, October 28th. We're going to get to a number of the interesting things. It's obviously another heavy earnings week with 3 of the FANG stocks, Facebook, Apple, Google, or Alphabet all reporting this week. So a lot to talk about on the charts. And in the end, just a nice upside follow-through day. So we're going to break all of those themes down and more. Before I get there, I just want to remind everyone, just in a couple weeks, this is next week, at the end, we're going to the Traders Expo in Las Vegas. It's November 7th through 9th. It's in Las Vegas. You can register at stockcharts.lasvegastradersexpo.com. I'll be doing a presentation Friday evening talking about the 5 modes of mindful traders, where we'll talk about how to get in the right mindset and handle some of the behavioral biases, handle your emotions, build better routines. So I certainly hope to see you there. And if not, if you can't make it to Las Vegas, make sure you check out the website, because I know there are a number of streaming options you can explore. So looking at the markets today, we've talked for weeks now about upside follow through. And when we have a big up day or big down day, it's all about tomorrow. It's all about the next day and what sort of follow through we get. So I would say over the last 2 trading days, with Friday's session and then following with today's session, there is no way, I think, based on just purely the price action, that you could justify being too negative on the markets here. And again, I've been cautious talking about, breadth issues and small cap issues and, individual names that aren't performing as well, defensive leadership. In the end, all that matters is price, right? And the price is undeniably going up and to the right. And so long and strong up and to the right, that the price is going up means the price is going up. The market is going higher. It's a very resilient tape. And again, with all the headwinds out there, or proposed prospective headwinds, things like trade issues and earnings, and it's going to be a weaker earnings season, and there could be all these geopolitical issues. None of that matters as long as the price is going higher. So this is a great reminder to not get too caught up in the news flow, not get too caught up in potential catalysts. Focus on the price. Focus on what's actually happening on the charts. So with Friday, we had this this big up day. You could call it a bullish engulfing pattern. I think that's a bit dishonest, not dishonest, but it's a stretch, only because that pattern should happen in a downtrend. That's something that happens after a sell-off. But it was certainly a sign of accumulation, opening lower and then closing up on the day. And then the follow through today was certainly significant, getting to a new closing high, a new price high, closing around 30.39. Looking at the action during the trading day, a little bit of sell-off at the end of the day, but overall, a big gap up from Friday, and then just sort of stayed, steady Eddie up in the upper end of the range. Pulled back a bit in the last 30 minutes, but overall, nowhere near the lows. It held up very nicely. So, now we have 4 straight sessions where we've had, clearly accumulation over distribution, a lot of names breaking to new highs more and more, in fact, which is certainly a sign of potential long-term strength. So those issues that we've talked about, some of the internal challenges with the market, appear to be alleviated in the fact that the market just keeps going higher. So again, price is price. That's the number one thing you want to pay attention to. So looking at some of the charts that we've paid attention to, there are plenty that still are suggesting a little bit of caution. And the first one that comes to mind would be consumer discretionary versus staples. This is offense versus defense in the consumer space. Nowhere near this breakout. And there are a number of reasons for that. Obviously, a number of charts within consumer discretionary, weaker versus stronger. Restaurants come to mind as a group that had been so strong and now, really rotating lower. And in staples, you have some pretty good charts. And overall, that's what's holding this ratio maybe artificially down, right? It's still, overall favoring staples over discretionary for the last 6 months. But look at the next chart. This is another sort of macro tell. As you know from hearing me at times, hopefully, I love to ask interviewees what their one chart would be. What's the one thing you would want to have in front of you? The chart of semiconductors relative to the S&P might be my one chart more often than not. And here you have this rotation on the SMH, which is a semiconductor ETF, testing resistance, failing a bit, but then, breaking through, closing to new highs there. So, overall, you have semiconductors leading and outperforming. Again, going through earnings season, seeing some of the stocks jump that have been jumping, I think is what's so important. Those are the themes that we'd be looking for. Leadership today is certainly feeling more offense than defense, with technology at the top, up 1.25%, followed by healthcare and communication services, both up about 1%. At the bottom, we have some of the defensive names and groups that have been doing very well. So utilities, real estate at the bottom, underperforming on a nice up day, and then energy down a little bit. Energy had led a couple days last week. So, some really interesting themes there. Looking at the scooter reports, and again, I encourage you to pay attention to these to think about some of the names that are shifting around. Tiffany's very quickly jumped to the top of the ratings list and the biggest up move today with the huge gap on a buyout rumor. So, certainly a huge move. And again, with something like this, I still think the chart is really important. But it's all about starting where we're at, seeing where we're at, and looking to the left, seeing where we're at relative to some of those significant highs and lows. So with this huge gap up, now going into last week, this is a weekly chart now. Weekly chart, the Tiffany's had closed to a high for the last 6 months, which was pretty promising, looked encouraging. Maybe we head to the previous highs. In one day, we've now gone to the previous highs. The challenge now is we're in this resistance area, which is where Tiffany's topped out before. Now on a buyout, a lot of times you'll find charts go flat as they sort of digest a new buyout price, the level at which things are going to get executed. But certainly worth paying attention to and seeing if there's some interest there. And then again, charts like applied materials maybe come to mind, which this is within semiconductors. We looked at the relative performance of semiconductors. Again, if you know nothing else about what's going on, stocks like this breaking to new highs consistently for the last 3 days, certainly you have to think more on offense than defense. You have to think about more potential upside than downside. So, overall, this was clearly a follow-through move. Upside, more of an accumulation, more showing buying interest than selling interest. I don't see anything besides the warning signs that have been present that haven't quite been resolved. Still showing some healthy upside. So again, really quite the bullish start to the week. We'll have to see with earnings how that plays out through the rest of the week. So that's your market recap for today with the upside move here. Second segment for today is opening up the Final Bar Mailbag. As you know, 2 ways to get a hold of us. You can, 3 ways actually. Number one, during the show, please put questions in the chat room that's open on the side of the StockCharts TV monitor. We are always looking at that. If we don't get to your question during the show, we keep all of those and try to get to them during a mailbag session. So if something catches your eye and you can just pop it in there real quick, we'll make sure we capture it. Second thing is the Final Bar at StockCharts.com. And the third is on Twitter at Final Bar SCTV. So hit us any of those ways and we'll make sure that we come back to them when we can. We've had a number of questions in recent weeks specifically about ETFs. This is an area that I find, especially with individual investors, a lot of times is misunderstood. And a lot of times when you buy or sell an ETF, there are a lot of factors that could cause that ETF to go up and down. And a lot of times there's sort of an unintended bet or unintended consequences that can come out. And a lot of times it's based just on how the ETF is constructed. So what I wanted to do is just hit on a couple of the questions I've gotten recently and hopefully try to bring to light some of the issues you might be dealing with and hopefully bring some clarity to it. Someone had asked about the momentum ETF that I referred to last week, MTUM. I have a page, this one right here, this candle glance page that I usually have up, looking at the main factor ETFs. This is momentum, quality, which is really looking at earnings strength, size, which is essentially smaller companies versus larger, value, which is a play on the traditional value methodology, minimum volatility, looking for stocks with a lower volatility profile, and then momentum is based on price strength. owning stocks that have worked. So this is a great way to just visually compare some of these different factors. And I have this performance chart that I've created that just shows you returns based on each of those factors with the S&P 500 in the middle. So you can start to see what's been leading, what's been lagging relative to a certain starting point. Now, the question was in particular about the momentum ETF, and the question was, what is that actually giving me? Because the biggest name when the person looked at the listing was Procter & Gamble, PG. Now, PG, if you know your stocks, not something I would consider a growth name or a momentum name, right? P&G is sort of the sluggish consumer staples, kind of big and stupid, if you excuse the expression. That's what we'd always call some of these big sluggish names. It wasn't really a bet on the juice. It was just sort of a place to be if you needed to own some names and hide somewhere. But it's been doing very well. So what I would remind you with momentum is there is a big difference, number one, between growth and momentum. We're going to talk about growth and value in a minute, but growth doesn't necessarily mean momentum, right? Growth is based on growth characteristics. So companies with strong earnings growth and those sorts of characteristics. Price momentum sometimes can factor into that, but it's really more meant to look at the fundamental drivers for growth. And it's trying to capture companies in a growing phase, not in a more mature dividend paying value type phase, right? A more mature company. So growth stocks can be momentum oriented, but not necessarily. Momentum just looks for stocks that have had strong returns recently. So in general, you list all the names. Let's say you list the S&P 500 from 1 to 500 or so, however many names, tickers are in there at the minute, and you rank them in order of some sort of performance measure. So a lot of times it'll be 6-month performance returns, 12 months, 12 minus 1, something like that. And you take the top decile or the top X number of names, and that is your strong momentum group. And it doesn't matter what the fundamental characteristics are. They could be energy stocks, utility stocks, consumer staples like Procter & Gamble. So the reason why this is such a big bet in a momentum ETF is because of this right here. This is the relative performance of P&G versus the rest of the S&P 500, outperforming that index by 24% over the last 12 months. That's a market leader based purely on the price profile, and that's why it's a top momentum name. It does not mean it's a growth company, far from it. Just means that the price has actually been very strong. So when you're looking at the MTUM, the momentum ETF, you're looking at a lot of different types of companies, but they're purely the ones that have had strong performance, in particular relative performance, because they're the top ranked stocks if you rank them all in performance order. So that's the question on MTUM. Thanks so much for asking about momentum stocks. The second question was on growth versus value. And someone had asked in particular about two ETFs, the IVW and the IVE. Let me go real quickly to some ratio charts. Here we go. So what we're doing here when we're looking at growth versus value, I've often showed two different charts for this. I often look at the IWF and the IWD. These are the iShares ETFs tracking the Russell 1000 growth and value indexes. I also will show the pure growth and value, the RPG and the RPV. Those are the S&P 500 pure growth and pure value indexes. This person had asked about this one in the middle, which is the IVW and IVE, the iShares S&P growth ETF and the iShares S&P value ETF. So I would say, remember, with things like this, these two indexes and the indexes that these ETFs are based off of, they're taking members of the S&P 500 that exhibit classic growth characteristics and those that exhibit classic value characteristics. So something like growth, it's going to be earnings growth and momentum. More value is going to be price relative to book value, relative to sales, relative to earnings, things like that. Where is it trading relative to where it should be trading based on some valuation measure? And again, they're done sort of the same way. So this is going to be more growth-oriented names in the index. This is going to be the more value-oriented names in the index. So if you're looking at IVE, which is the iShares Value ETF, right, what would you guess is the number one holding in the iShares Value ETF? Big value-oriented index looking at value names. 9% of the index, the biggest holding, is Apple, which we might consider more of a growth-oriented company. Arguably, it's in a more mature part of its experience, of its life trajectory, but Apple is almost 10% of that index, by far the biggest holding. So this specific ETF, this index, is going to be driven a lot by a big move in Apple because it's such a big stock, it's such a big weight. What would you say is the biggest sector represented in the iShares Value Index or iShares Value ETF? It is actually not technology. It's not a consumer sector. It's financials with about 24% of the index. So about a quarter of the index is financial stocks. So now you have 9% Apple, 24% banks and other financials. And now you get a sense of how an ETF like the value ETF, IVE, while you want it to be a pure play on a value factor, which in a lot of ways it's trying to do, you do have a lot of specific stock exposure, in this case to Apple. You also have a lot of sector exposure. So in this case, you have a quarter of your bet in the financial sector. So if there's some situation where financials start to dramatically change positioning, that's going to make value as an ETF, as a factor, look dramatically stronger or weaker. So I guess this is a cautionary tale of sorts, just to remember when you're looking at an ETF like IVE, like IVW, which is the growth ETF, make sure you dig in a little bit and see what bets you're making in there. A lot of times the way it's constructed, and to say nothing of things like the expense ratio and other stuff, can certainly impact what you're doing. And it might not necessarily be a value factor doing well or poorly. It could just be an exposure in there. The final question specific to ETF, and I hesitate to blow too quickly through this, but I did want to make sure I touch on it, was China. So we've talked about China a number of different times, and I just want to point out there are a couple of ETFs that I often use. The most common one I use is FXI, which is the iShares China Large Cap ETF. This is based on an index called the FTSE China 50 Index, so it's 50 stocks, big large cap names traded in Hong Kong. So it is not mainland China. It's not stocks traded in Shanghai, traded on what they call the air shares. These are stocks traded in Hong Kong. The other one would be MCHI, which is also based on it's an iShares index, but this one is based on the MSCI, China ETF, which is a much bigger basket of stocks. There are other ETFs out there like GXC and others. ASHR is the A-share ETF. These are based off of the mainland A-share, so they will be more heavily skewed towards companies that actually trade on mainland China. And the challenges with those, again, with any of these, if you look at the FXI, for example, what would you say the biggest sector is on this ETF? Financials, and you're not going to believe how big it is. It's over 50%. 56% of this ETF are financials traded in Hong Kong, sort of China-oriented stocks. So with that one ETF, you have a huge exposure to the financial sector. Again, within that region, granted, but still it's a big sector bet. Other ETFs are completely different, where financials will be 9, 10%, if not a little bit more of the ETF. So a lot of people have asked, where do you get construction and details on this? It's not something we have on StockCharts.com. So I often go to ETF.com as just a quick way. If you type in the ticker of an ETF, it'll break down sectors, regional themes, all of those things, also expense ratios and others. So take a look there. And again, this is just a cautionary reminder to make sure when you're looking at an ETF like a value ETF, you're actually having exposure to a lot of different themes, and just make sure you know where you're getting some exposure. So that was the mailbag for today. I hope this helps you think about the ETF space a little bit more. We're going to take a brief commercial break. We'll be back with a deep dive on the communication services sector. See you in a minute.
Today's market volatility provides savvy traders and active investors with an abundance of profitable opportunities. At the Traders Expo Las Vegas, November 7th through 9th, over 75 of the most respected traders in the world, including Dennis Gartman, Tom Sosnoff, Todd Gordon, and Tom DeMark, will explain how they're adapting their strategies and share the specific trading opportunities they've identified in equities, options, forex, futures, cryptocurrencies, and more. Claim your free pass to join them at tradersexpo.com.
Hello, everyone. Welcome back again to the Final Bar. This is Dave Keller here at StockCharts.com. Appreciate you joining me today on our Closing Bell show. We're going to continue on with a sector deep dive. We'd like to occasionally look at a specific sector, dig deeper into some of the themes, some of the stocks making movements. And again, our goal over time is to hit on all of these sectors one by one and try to help you focus on some of the things that you might want to understand a little deeper than just the sector ETF. Now, last time we actually started with the communication services sector. We didn't get that far on it, so I wanted to sort of revisit that, look a little bit deeper into some of the larger names, in particular some of the groups. Think about how this sector is actually laid out. So the ETF for this is actually XLC, so it's one of the 11 S&P sector ETFs. This was actually started a couple years ago. It took bits of the telecom services sector like AT&T and Verizon, some of the internet retailers, things like Facebook, Amazon, and also some of the media companies like Disney, Comcast. All of those are in the group as well. So it's really a mishmash of offense and defense. There's a lot of things that, obviously exposed to internet strength, internet security, the 5G spectrum, all of those sorts of things. So there are a lot of really interesting themes that can be played in here. On the industry summary page, and if you're not familiar with that, you have to go to Charts and Tools and click industry summary from there. But this is a great way to sort of break down some of the groups within this. Uses the Dow Jones industries, which are a pretty good way to break down a sector into its components. Here I'm just looking at the performance today. I thought that would be a good starting point just to break down each of these groups, telling you a little bit about them, some of the key names, and then see what we can see. So fixed line telecommunications, these are sort of the traditional Ma Bell types of names. These are things like AT&T, Verizon, CenturyLink, I think is in here, those sorts of things. This group overall has done pretty well, particularly because of the dividend component. So a lot of these names like AT&T, Verizon are have a big dividend component to their returns, high dividend payers. And as a result, when you adjust the data, which is what we're doing here, you see a lot of upside move to it. And on the relative basis, so this is the specific industry group, fixed line telecom names versus the S&P, sort of flatter until August, and then it really accelerated. So overall up 13.5% relative to the S&P year to date, over the last year. A lot of that has come just in the last 3 months for sure. Testing new closing highs, not quite there today, but really, really close. So if you go back to the industry summary page, you can click on it. This will give you a breakdown of some of the names. You can see what's up and what's down. AT&T just coming out with earnings today is what has caused us to go to the top of the list. You can see AT&T on a relative basis, a strong performer. That has to do in a lot of ways based on price, but also the dividend component pays a 5.3% dividend yield. So it's a pretty significant way to gain income as an equity investor. Testing new closing highs, not quite there, but very, very close, up over 4% today on a nice up day. Another thing you can do is sort on scooter rankings. This way you can see that AT&T is at the top of the list. Other large cap names you might be familiar with, CenturyLink, CTL is another one. So what's interesting about a chart like this, it's been an underperformer dramatically, and a lot of that has come in the first half of this chart in the first 6 months here from last November to May. Look at how the price was just down. This is when stocks rallied out of the December lows and had a nice beginning to the year and then have continued to appreciate. But look at what's happened in the last 2 months, where now you've rotated back above the 200-day moving average, back above the 50-day, now just stabilizing and potentially starting to go higher. So even some of the smaller names in that group that have not been leadership started to do pretty well. And Verizon's the third one looking here. If you look at just the price of Verizon and AT&T, you can see AT&T's have been in a much better technical picture, although Verizon has broken out on a relative basis, nowhere near the positive returns that you saw from AT&T. So those are the names in that first group, fixed line telecommunications. Let's go quickly through the rest of these. This is the internet space, and if you look at internet stocks, not a bad price, holding up on a relative basis, outperforming 4%. And again, that's come up very well in the last couple months, but a lot of resistance here in the May and August, or April and August highs. But if you look at some of the names within that group, Spotify is an earnings name. It's obviously jumped pretty good. So that's what that looks like when you have a big earnings release on a stock. Had been a real underperformer. You look at how this had gone to new lows, but then just started to chip away, go higher and higher. And in one day now back above the 200-day, overbought. So again, with something like earnings, you always want to see what the follow through would be the next day. Looking at all of these just based on the entire list, you can see that the internet space has things like Alphabet. This is a stock coming up later. Also the video game names like Activision. So Alphabet, nice move today, a nice follow through to what we saw on Friday, up just under 2%. So nice outperformer today. Again, testing all-time highs, but not quite there. So 1,300 is the real significant level. Back to positive returns for the year, which is impressive. Overbought now, or just above that overbought region. So it's sort of on the red flag list, just seeing if this is the beginning of further momentum or if this is potentially a time to take some profits on a name like that. Again, earnings this week, so you have to pay attention to that as a potential catalyst. Also within video games, you have things like Take-Two. So it's always interesting to see at an index level or at a group level, which stocks are going lower when other things are going higher. So here, Take-Two with a bearish engulfing pattern, while most stocks were actually going higher, and something like Alphabet up to new highs, the internet names up to new highs. You have Take-Two sort of testing new lows. And video games in general have been a little bit more challenging than elsewhere. Here's Electronic Arts, another video game name. So again, not a horrible chart, not going to new lows, but you think about what the average chart looks like, and it looks a lot stronger than this. And that's why the relative strength has been so weak. So some of those names, a lot less attractive than others. You then have media agencies, which is a little bit of a different group. I'll look at here very quickly and see which names pop to the list. Yeah, IPG actually is a really interesting chart. This is one we've talked about because it's popped up on the scooter list. I always screen for new 13-week highs. That's something that I pay attention to. IPG is just getting there. A couple nice big up days. Actually, the last week has been pretty strong, starting with that first up move. Now back above 2 upward sloping moving averages. A new 13-week high in relative strength, very, very close. So potentially an emerging name within that space as well. Publishing is in here. I want to go very quickly through broadcasting and entertainment. So these are some of the larger media names, things like Comcast, Disney, and others. So there are charts like this, Charter Communications. So if you look at some of the higher scooter rankings within the name, Charter's certainly going to be at the top of the list for communication services. A strong outperformer and a consistent uptrend of higher highs and higher lows. But a lot of other names in here, especially in the mid and small cap space, which you might not be as familiar with, which is why this industry summary page can be pretty good. You can take a name like Charter or Disney, which you are interested in, and then dig a little deeper and see what other names might give you some of that exposure. I want to finish with a look at Comcast. This is a challenging name. The big bearish engulfing pattern last week, this was last Thursday, coming off of resistance, so traded to new highs and then immediately sold off. Now new relative lows, almost a new 13-week low. So more of a rotation to weakness versus strength during that period. That is it for a deep dive in communication services. Boy, that goes so quickly. And I hope this is helpful. Again, for me, I like to do what we just did and just spend a lot more time at it, starting with the industry summary, looking at the charts of the individual groups, digging into some of the names and looking at the scooter rankings and finding which names are in a position of strength, which are in a position of weakness. And I think with communication services, you actually have a pretty broad spectrum of returns from stronger to weaker. I want to finish off the show today with the 3 and 3. So what we love to do is look at 3 charts that you should be paying attention to. If these are not on your radar, I certainly hope they are now. We're going to start with Dow theory. This is a traditional, look at Dow Industrials versus Dow Transports. This has been around for over 100 years, this methodology of looking at the producers and the distributors of goods. In this case, we have transports breaking to new highs for the last 3 months, breaking above the high from July and the high from September. That has not quite been validated on a closing basis from Dow Industrials. So we have the high in July, a lower high in September. We're testing it, but have not broken up. So on a pure Dow theory read, on my interpretation, on a closing basis, you want both of these to be breaking to new highs. And that's what would confirm each other. So at this point, you are unconfirmed because you have transports to new highs. Not quite there with Dow Industrials. A number of my guests the last couple of weeks, including a good conversation with Ralph Atkimpora in Minnesota a couple of weeks ago, focused on transportation stocks and why that's an important emerging theme here. The second 3 and 3 is semiconductors versus the S&P. We looked at this a little earlier. And again, depending on what you use for semiconductors, the SMH versus some other ETF, this might look more or less attractive based on what you use and based on the construction of the ETF, going back to our earlier discussion about ETF construction and challenges. But this on a relative basis has broken to new highs, clearly a follow through to the upside. So again, if you know nothing else and this is your one chart, you have to be more bullish than bearish at this point, just because the price is following through to the upside. And again, a lot of times with the markets, I would tell you that the charts will start, the price will lead. The fundamental reasons why a chart looks so good will become very relevant or very obvious down the road. At the time, if you're going to pay attention to one thing, pay attention to the price. The third of the 3 and 3 would be a China ETF. We talked very quickly about some of the China ETFs. This is the one I use the most common because it's very liquid, very widely followed, the FXI. This follows the FTSE China 50 index. The reason why I do is because I like to pick one and just use it consistently so you get how the patterns have evolved. Using a trend line from the April and June highs, we didn't quite get there last month in September. We did get back up there, and just today with the gap up, we're back above the 200-day moving average. We're back now above this trend line for the first time. And now we see this potential rotation. A break to new highs, which would be above 42 on the FXI. That would confirm, sort of be a follow-through. Breaking above the September high would suggest a rotation to more of a bullish phase. And I think you would see the relative performance start to appreciate as well. So that's the 3 and 3 for today. And ladies and gentlemen, that is our show. I want to thank you so much for watching the Final Bar. We appreciate it. You can get questions to us anytime, and please do so. You can email us at thefinalbar@stockcharts.com. Get to us on Twitter at FinalBarSCTV. And if you've not checked out our YouTube channel, please make sure you do so. All of our old interviews, old episodes are all on there for you to watch, as well as the other shows. For our StockCharts.com in Redmond, this is Dave Keller. Have a great night.